What happens to your tax bracket the year after one spouse passes away? Most couples don't know. Most retirement plans never model that shift. Joint returns disappear, single tax brackets become much narrower, and the same income can be taxed very differently. Nothing reckless happened, nothing dramatic happened, but structurally everything shifted. And over time, that shift becomes expensive. Most couples spend years planning retirement income. They look at savings, they look at Social Security, they plan investment withdrawals. But there is one structural layer many plans never model: what that same income looks like after one spouse is gone. Not emotionally, structurally. And this is where the mechanics start to matter. Carl models this regularly. Carl, when filing status shifts from joint to single, what is the first structural impact that shows up?
The first thing that changes is the size of the tax brackets. When couples file jointly, those brackets are wider. When the surviving spouse of a couple files as single, those brackets become much smaller. So the same income that once fit comfortably inside a joint bracket can move into higher marginal rates. Nothing about the income actually changed, but the structure around that income did. And the shift alone can change the tax exposure. It is also important to understand something else. Several income thresholds compress at the same time, such as Social Security taxation, capital gains thresholds, and Medicare income limits. These all begin interacting into a narrower structure. Again, nothing dramatically changed, but structurally, everything tightened.
We've recently modeled this for a couple approaching retirement. They felt confident about their income structure. Their projected retirement income looked stable. But when we modeled that same income under a surviving spouse filing structure, their tax exposure increased meaningfully. Not because they were doing anything aggressive, not because income suddenly increased, just because the brackets narrowed. It was purely structural. And this is a structural blind spot. It is common, it is understandable, but it is built into the system. Most couples plan retirement income while both spouses are alive. Very few plans model what that same income looks like after one spouse is gone. Filing status changes, brackets compress, income interacts differently. And if that has not been modeled into your plan, it has not been coordinated yet. Then over time, that blind spot becomes expensive because retirement income rarely comes from one place. Social Security, IRA withdrawals, taxable portfolios, inherited accounts, Roth conversions, even Medicare thresholds all begin interacting differently once filing status changes. When those layers are not coordinated, tax friction builds quietly over time.
Another layer retirees often do not anticipate is how Medicare premiums interact with income. Medicare uses a 2-year look back. If income rises due to withdrawals or filing changes, premiums can adjust based on that income. It does not happen in every case, but again, it is structural. Higher income can influence Medicare Parts B and Parts D premiums.
And this is why Social Security should never be viewed alone. Sometimes claiming is optimized, but the income layering around that decision is never revisited. Sometimes investments are managed well, but withdrawal sequencing is never re-engineered after a transition. That does not mean anything was done wrong. It may simply mean the plan was never stress tested under both filing structures. And transitions change structure. The time to coordinate income structure is not after a loss. It is while both spouses are still sitting together. Because once structure shifts, you are adjusting. Before it shifts, you still have options. When we begin working with families, we start with a simple question. What do you want retirement to look like for both spouses? Then we evaluate whether your income structure supports that vision under both filing statutes. Because if your plan has not been stress tested under both structures, you do not yet know how it behaves. And that is exactly the type of coordination we focus on. Please like, subscribe, share this episode with someone who may need it. And remember to be financially prepared for today and the uncertainties of tomorrow.